Well, it was another sell-off day on Wall Street where we saw most of the U.S. indices closing in the red yet again. Seems to be a theme for October. We also saw most of the indices touch a new low on an intraday basis, at least a new multi-month low. But on the flip side of the coin, we did have some buying at the end of the day, so we closed well off the day's lows, and the closing prices on most of the indices did not have a new closing price low. So intraday lows, but not necessarily closing price lows. I also want to take a peek at the candlestick formation on the Russell 2000 that gives us a little bit of hope that perhaps we're getting closer to the end of this downdraft in the stock market. And in today's trade application, I want to focus on a serious dividend raising company to the tune of a company that's been raising dividends for the last half a century. And it's a company that did report earnings today, and Wall Street was not too happy about that report, but perhaps we can find a trade that might be acceptable here in the Market Outlook video. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 23rd, 2018. For those of you that are new, first of all, welcome aboard. We're grateful to have you in our audience. Remember, you can subscribe to our YouTube channel, and while you're over there, you can go to our description area and sign up for our email distribution list that'll entitle you to not only an alert whenever we do produce these videos, but it'll also give you a heads up on which stocks are going to be giving us overbought and oversold cluster signals. Of course, these days we've been getting a lot more oversold signals, so make sure you're taking a peek at those emails when you receive them as well. In addition to YouTube, we're heavy users of Twitter. We'd encourage you to follow us there. My handle is @BrandonVanZ. And if you ever see these Market Outlook posts there, we would encourage you to click like and retweet if you get value out of them. We're also on Facebook. Check out our group. The web address is embedded in the logo in front of you. All right, with that, let's go ahead and dive into today's analysis. As you can see here, I've got chart 4B pulled up for those of you that are Premium Market Scholars subscribers. And this particular chart setup is going to show us the four major U.S. equity indices in the United States, kind of side by side by side by side. And these are 3-month daily candle charts that we're looking at here. The background color of the chart will determine whether we have a bullish posture or a bearish posture on these various indices according to the market forecast intermediate term line. And so the market forecast, is a reminder, is found on the Thinkorswim platform or other resources at TD Ameritrade. So let's get into some of the analysis here. You can see the S&P 500 did pull back today. It was down 0.55%. And that was enough of a pullback to have the posture convert to a bearish posture here yet again. And you can see that we hit a new low, at least a multi-month low. Remember, we're not hitting all-time lows or yearly lows or anything like that, but we do have a 3-month low that we're dealing with here on the S&P 500. We touched 2691 approximately at the lows of today's session. But by the end of today's session, notice that we rallied 50 points or thereabouts, 49 points. And so we closed at 2740, even though we were touching 2691 at one point. So that was a pretty strong rally in the middle of the day. And you can see where we closed the session would have been considered about right here where my cursor is. And so you'll notice that was slightly higher than the closing price that we had back on this day, back here earlier in October. So maybe a little bit of good, a little bit of bad mixed in there, depending on your perspective. What we do know is that we've had deterioration and some breakdowns in the charts. We've had breakdowns in support levels. We clearly have a downtrending moving average at this point as well. This is a 30-day moving average that we've applied right here. Also noteworthy is that today's range was pretty extreme. You know, it's a roller coaster session where we saw heavy selling and heavy buying, depending on what part of the day you happen to take a look at the market. But notice up here in this orange label, it tells us what the daily range was. It was 62 points from high to low on the S&P 500 today. It's colored orange because that number is higher than the average true range, or whatever the typical range of the S&P 500 has been recently, which has been about 35 points. And that's the case in all four of our charts. Notice all of them are orange. Remember, that label will turn blue if there's a day where we did not achieve a daily range that was excessive over the average true range. So the point is, we still have a lot of people that are selling stocks. The buyers haven't completely dried up, but at this point, we still are dealing with a bearish market in all four of our charts cases. Now you'll notice most of the charts look very similar to one another, where we've got a bearish posture here with the Dow Jones and the NASDAQ as well. The Russell 2000 is a little bit of a different looking chart here, not necessarily because it's not bearish, it most certainly is, but it's been bearish for a long time without any sort of breather in between. Notice that this dark pink shading here is telling us that we have a strongly bearish posture, as opposed to like when you see this light pink over here, that's a weakly bearish posture. So we've had a strongly bearish posture really going back since the end of September. So nearly an entire month without a posture change from that perspective. Now you'll notice we've had a lot of cluster signals along the way, which occur when we have all of those market forecast lines in the lower reversal zone on the same day. In fact, let me do this. I'm going to right click on that chart. I'm going to go to maximize sell, so that way we can see the Russell 2000 a little bit better on one grid right here. And so you'll notice that when we have this green, this blue, and this red line all huddled up in the lower reversal zone on the same day, that's what constitutes an oversold cluster signal. Now, just because we get the signal does not necessarily guarantee there's going to be a buy type of a moment. What it's basically trying to tell us is that the instrument moved too far too fast, and it's unlikely to go down at the same pace over the same time period going forward. So in other words, it would be unexpected, let's put it that way, if we would drop another 200 points from the Russell 2000 going forward, right? We dropped from basically 1700 here at the end of September to 1500 today, right? 1501 was the intraday low. So that's 200 points off the top there. And so when we start getting these cluster signals here, it doesn't guarantee that this market is going to go up or even sideways. It could continue to drift lower. We just would not anticipate that, you know, if we're looking at the market at the end of September, like 1 month from now, that we would be down an additional 200 points from here. Now, of course, anything can happen. The markets are going to do whatever they're going to do, but unless we have some sort of major news development, and remember, we do have the elections that will come before then, so there's certainly some reasons why investors could get a bit skittish, but just purely from a technical analysis perspective, we would not assume that we'll have another 200-point move lower in the coming month. The one thing I wanted to mention regarding the Russell 2000 chart that did catch my eye today that I briefly mentioned in the intro was this hammer candle, or at least the start of a hammer candle. We kind of need the following day as confirmation of that. But a hammer candle is the one that's shaped like this, where we have a long lower shadow as part of the candle, and the top is kind of looks like a box. Some of you have referred to that shape of a candle before as a hanging man, and that's true. Like over here, notice what I'm pointing at here. This is considered a hanging man, and boy, oh boy, if we could all turn back the clock and look at that as a potential, canary in the coal mine at that point. Of course, it's difficult to pull these things out in real time, but a hanging man candle will occur at a resistance point, right? When we're up here struggling to go any further and that shape of a candle exists, it's telling us that market participants are not encouraged enough to push the price of the securities higher. When we get that shape of a candle down here close to support, right? Support would be like where we've had this range here in the last couple of weeks with the Russell 2000. Then that shape of a candle turns into what's known as a hammer, and that's actually a bullish sign. Up here, that would be considered bearish. Down here, that could be considered bullish if we just get a few elements of some positive news stories, or even some earnings reports that come in a little bit more promising. More of the earnings reports today, Caterpillar, etc., were struggling, but we did have McDonald's that was to the upside today, and I know Boeing reports tomorrow. There's a number of big names that will be reporting in the coming weeks, and so if we can just get a little bit of a fire lit with some positive earnings reports, perhaps this hammer rate here could lead to at least a little bit of a reprieve, a mini reversal to the mean, even if it doesn't mean that the trend of the Russell 2000 will change in a dramatic way. So let's keep our eye on that as the days and weeks go on here. Let's go ahead and take a look at a few more charts while we're at it. Let's take a peek here at the 1040 crossover. I wanted to discuss this as well. Remember, the 1040 crossover is a weekly candle view. This is chart 4D for those of you that are premium market scholars following along at home. And the chart that I wanted to look at and spend some time looking at again was the Russell 2000. Notice that the S&P 500, the Dow, and the NASDAQ composite all are in decent shape where we still have that green background color, and the orange moving average is well above the blue moving average. But when we eyeball the Russell 2000, it almost looks to the naked eye like the Russell 2000 is about ready to cross right now. So let's kind of zoom in on that and examine that a little bit closer. I'm going to right click and go to maximize sell, and you'll notice that we're not quite there. We're getting awfully close. And, like we've been saying for the last couple of weeks, if there is going to be an index that does have a bearish crossover on the 1040 crossover method, it's likely going to be the Russell 2000 that does it first. And that's still where we stand at this point. Notice that in the past, we have traded below the blue line, which in this case would be the 40-period exponential moving average. Remember, this is a weekly candle chart. So for those of you that are used to daily candle charts, think of that as like your 200-day moving average there in blue. Well, you'll notice that there's been a couple of times where we've gone down there and we've touched the blue line, like right here, we touched that blue line. Here we almost touched that blue line, maybe we did. Here we touched that blue line, and here we touched that blue line. But you'll notice that this is different, meaning that we have not closed 3 consecutive weeks below that blue line for a very, very long time. The last time that would have occurred would have been back here when we had that bearish posture. We know that was bearish with the crossover back there because the background color was pink. So the point being, this is a lot of very excessive selling that we've been seeing in the Russell 2000, and it would not be surprising at all to me to see a bearish crossover here in the coming weeks with the Russell 2000. So what that means for you is, if you believe that negative price action will lead to further deterioration in the market, then perhaps liquidating that portion of the 401k or wherever you might have that in the paper money account could make some sense. Remember, this style of investing here is not a sensitive style. What I mean by that is you are not making daily decisions in and out the way that, let's say, a swing trader or a day trader would. This is trying to capture the majority of the trend and then understanding that you'll never buy the bottom or get out at the top. So when you would have bought last time on the Russell 2000 would have been back here when we had that crossover occur. That would have been June of 2016. You would have been buying the index at about 1133. So even if you are going to force yourself out of the trade around these levels, you still had a very nice move from 1133 to wherever we're at right now, close to 1500. But it does take an understanding that you're not going to be able to sell right up here at the top like everybody would hope for you to believe, right? They don't sound a bell at the top, and they don't do it at the bottom either. So you have to understand, you can't really look at that with regret. Just take it for what it is, that you're trying to capture the juicy part in the middle, and then you wait for your next setup. Let's take a look at a few other charts while we're at it here. Let's take a peek here now at chart 4E, which will be our intermarket analysis 12 grid. And as a reminder, when we're looking at this particular chart setup, the background colors will tell us whether we have a bullish posture using the intermediate term line on the market forecast or whether we have a bearish posture using that same intermediate line. And so as we look at this, everybody's been focusing on the VIX here lately, or at least a lot of people have. We did close higher on the VIX today. In fact, we closed above 20 yet again. We closed at 20.71. That was good for a 5% move to the upside. Now, again, that's fairly normal. When markets sell off, volatility goes up. Now, similar to what I mentioned before, where most U.S. equity markets closed off the lows of the day, the VIX closed well off the highs of the day as well. So when people started going in there and buying stocks up on an intraday basis, they started selling the VIX off. So we still closed higher, but it just wasn't as dramatic as it was earlier in the session. It does retain its bullish posture, if you want to call it that. Remember, you gotta think of that in opposite terms. So when the VIX has a bullish posture, that generally means that it's bearish for the rest of the market. You'll notice that yields retain their bullish posture as well. Yields have been in focus for several months now, as we see, the 10-year yield up there at 3.16%, and for the most part, that's been an upward trajectory there when it comes to yields, which means bonds have been selling off, which makes this a little bit of a different market. A lot of people, if they first start entering into the financial markets, they might wrongly assume that if stocks sell off, bonds have to go up or vice versa. And that is definitely not the case, particularly, if we go into some sort of an inflationary period here. So just be careful not to assume that will always occur. It can occur, of course, but it doesn't have to, is the point that I'm trying to make. As we look at some of these other charts here, we saw a big breakdown in master limited partnerships today. Now, energy got blitzed. You'll notice down below here, crude oil, the chart in the lower right-hand corner, crude oil was down 4.7% per barrel. Take a look at that candle right there. That's a really ugly candle. Now, we do have a potential buying position here, or support level, I should say, back in August. So maybe it can catch a little bit of a relief at around that level. But with crude oil breaking down as large as it has, you'll notice that has negatively affected master limited partnerships, which I'd say at least 80% of master limited partnerships have something to do with the energy industry, many of them pipeline companies. So that is not a healthy place to be. You got kind of a double whammy there, where you've got rising rates, which puts pressure on bond-like equivalents like these high-yielding master limited partnerships. And then if that wasn't enough, you got a falling crude oil price as well. So difficult place there for the time being with the master limited partnerships. Other areas that are holding up a little bit better, notice that the US dollar was down today, so it was down 0.16% today, and that led to a little bit of strength in gold and in agriculture commodities. So gold has been one of those areas that we've been focusing on a little bit more so here recently, because we had a long slumber with gold, but all of a sudden we're starting to break out a little bit here. Remember, sometimes investors will drift towards gold as a safe haven or a place to retain the value of their investment dollars if they feel like the bond market or the stock market is not offering them an attractive alternative. So gold attempted a major rally today. In fact, on an intraday basis, you'll notice here we did hit a new 3-month intraday high on gold. That's significant. Remember, gold has been in a long downtrend. In fact, let me do this. I'm going to right-click, go to maximize sell, and let's go back and take a look at what's been going on with gold for the last 5 years. It's been largely sideways, but you've seen kind of roller coaster action along the way. And where we've come from here recently is this long downtrend right here. Well, the last several weeks, so these would be weekly candles we're looking at here. So for the last 4 weeks, we've bounced significantly off of those lows right there. So keep your eye on gold. It could have some appeal here just simply because it seems like stock traders and bond investors are getting frustrated with their markets. And those investors and traders might start flocking towards something like gold when there's a little bit more of a chaotic market environment like we've been seeing here recently. Let's take a peek now at chart 4F. This will be the foreign stock markets 12 grid. Again, same thing. When you see the pink backgrounds is bearish, the green backgrounds is bullish. And the only bullish chart on the board is Brazil. This was another one that we identified a few weeks ago, and we recognized that, hey, Brazil's doing something different than the rest of the market. I recall talking about, what stock was it? It was Embrar, ERJ at that time. And this is a lot to do with elections. So be aware this is political in nature, but remember, there is no rule book when it comes to the stock market. Stocks will go up or down however they so decide. Right now, traders are suggesting that the political developments in Brazil are supportive of equity prices in that country. And so while it was down today, it was down 0.55, kind of matching the S&P 500's down move. Notice that we are very, very close to 3-month highs as it stands right here. And you can't say that for hardly anywhere else in the world. You look at the rest of these charts, not only do they have bearish postures, but many of them are scraping multi-month lows, right? There's Canada hitting a new low. There's Mexico hitting a new low. There's Germany hitting a new low, and United Kingdom hitting a new low. And I think that Australia hit a new low today as well, and so did Japan. So, we start looking at these charts and you start seeing how exceptional Brazil is. So if you are somebody that's looking for momentum in the market and you're looking for bullish trade setups, then perhaps Brazil is a place where you can look for some opportunities. Most of the rest of the world is really struggling right now, similar to the United States, and so those would be better bearish setups in many of the cases. Let's take a peek now at the U.S. sectors 12 grid. That's chart 4G for those of you that are premium market scholars following along at home. Now, as we look at this, notice there's only two bullish charts on the entire grid. And those are the two that you would probably assume to be bullish in a time when we have significant market turbulence. And the two that are bullish are the consumer staples and the utilities. It is true that those are some of the most boring areas of the market, but this is a time where boring is beautiful, right? This is a time where investors and traders are intentionally avoiding risk. They're intentionally going away from the high growth, high octane, highly cyclical areas of the market, and they're trying to hunker down into something that they perceive to be a bit safer. And of course, the electric utilities, they're going to be perceived as safe because even if you don't have your job, you're going to turn on your lights. And the staples, even if you don't have a job, you're still going to buy food at the grocery store. So, that's kind of the mindset of the trader right there. And we're seeing some of the same developments in my sector selector tool as well. I was on vacation here recently, so I didn't get it out on Friday night this week, but I did get it out on Sunday. Most of you have probably seen that already, but if you haven't, let me just pull it up here. There are some of the ranking movements that we've seen recently, and again, no surprise to see utilities retain their #1 position for the third straight week, but the one that did kind of catch my eye here a bit more, notice Staples. It's only ranked #4 right now, but notice just 4 weeks ago, Staples was ranked #9 here in the purple, and it shot from the 9th rank all the way up to the 4th rank. And again, that goes largely back to what we're seeing here in the sector rotation that's taking place, where investors are fleeing away from the high growth areas and fleeing towards some of those perceived safer areas of the market. If we wanted to take a look at how those various sectors did on a one-day basis today, let's go over to the Market Watch tab here briefly, and you'll see that real estate, consumer staples, and consumer discretionary were our top 3 performers today. Those were the only 3 sectors that closed in the green today, as you can see right here. And it was mostly, actually, it was a flat performance there out of the consumer discretionary names. On the downside, energy struggled the most. That makes sense. Again, going back to what I mentioned a moment ago, crude oil itself was plunging today, and therefore a lot of those oil and gas producers struggled today. We also saw industrials struggle here today on the backs of Caterpillar and 3M reporting some earnings here earlier today. We also saw materials struggling today, down nearly 1%. If we want to go in and take a look at some of the stocks within those sectors that have done the best and the worst to create today's action, let's take a peek at what's going on with the real estate stocks and the energy stocks. So for that, I'm going to come in here to my personal watch list, and let's start with real estate. And as we can see here, the best performing real estate stocks, in fact, we have a lot of them, a lot of those in the green there today. We saw Liberty Property Trust up 3% today. That's ticker symbol LPT. We had Weyerhaeuser, that was up 2.6%. That's ticker symbol WY. And then we had Ventas, which is a big healthcare REIT, up 1.7% today. That's ticker symbol VTR. So a couple stocks there, or in this case REITs, that are bucking the trend to the upside here today. Now on the downside, where we really struggled was in the energy patch, or the oil and gas patch, however you want to say that. And if we take a look at the worst performers from this perspective today, we saw Apache really struggling, down 3.6% today. Anadarko was down 3.2% today. Apergy was down about 4% here today. We had Antero down 3.6%, etc. In fact, there was worse. For some reason, it didn't sort there for me. So there was actually a few that were worse than those ones I just rattled off. Cosmos Energy down 8%. Neighbors Industries 6%. Extraction Oil and Gas down 6%. SM Energy down 6%. Transocean down 5%. I mean, it was pretty ugly out there, ladies and gentlemen, if you're in the energy patch. So just confirming what we saw there on those charts themselves, with investors fleeing away from some of the most cyclical areas that require a strong economy. All right, so with that information out of the way, let's now spend a little bit of time on our trade application example for the day. So what I want to do for this is come on over here to the charts, and I'm going to go to chart 3A, which is our dividend stair step chart. And as I pull this up here, just a reminder that this is the chart that we use in my dividend growth investing trading rooms. And in fact, I teach that trading rooms on Tuesdays. Earlier today, I taught one where we compared two companies within the financial sector in a head-to-head matchup as we're building out our dividend portfolio there for those of you that are premium market scholars. Well, I'll occasionally bring it up here in the market outlook videos as well if there's a reason to. More times than not, when markets are behaving themselves, we're probably focused a little bit more so on the high-octane growth stocks that are out there. But when markets turn tail and head south, what happens is stocks sell off. And remember, for dividend-oriented investors like myself, when stocks sell off, that presents an opportunity. The reason for that is the yield goes up when price goes down. And so you don't really want to buy dividend stocks when they're going up significantly because you're buying them at low yields. You would rather wait to buy them when they pulled back in price. Now, that's assuming that you are dealing with high quality merchandise, right? Our mantra is buy high quality merchandise when it goes on sale. This is a long-term view. So for those of you that are, short-term oriented, this is probably not your ideal trade setup. But with that out of the way, I wanted to show you one stock that reported today, 3M. This is a company that is a dividend aristocrat. In fact, it's a dividend king. For those of you that are not familiar with the term dividend king, it means that it's a company that's raised its dividends for more than 50 years in a row. Every single year, like clockwork, 3M raises its dividend. If that's not consistent, I don't know what is. Now, just because they raise their dividend every single year does not necessarily mean that it's a good fit for your portfolio. So in the end, you've got to make that decision for yourself. But what I try to train my students to do is look for opportunities in the highest quality names that you want to become a business owner of, and to do so when prices make sense. We're not naive enough to think that we'll catch the exact bottom. We did that one time earlier this year with Starbucks, but more times than not, we will not do that. More times than not, we're dealing with stocks that are in downtrends, and we're trying to capture somewhere near the bottom, not the exact bottom. And that's kind of what I find to be the case with 3M right now. Now, when 3M reported this morning, I had that sensation that, hey, I might very well be talking about this stock on the Market Outlook video tonight. I was kind of hoping that 3M would come all the way down to this orange line here, so that way we could just buy the shares outright. Because I know a lot of times you guys say, well, why do you guys always talk about those options trades? Why can't we just buy stocks? And, the reality is, each has its own pros and cons to consider, but this is a audience here that we have on the Market Outlook video that is a little bit more inclined to look at those options trades. If you are somebody that likes to simply buy the stock, then I would encourage you to join me in my trading rooms on Tuesday mornings for that. But this is a situation here where if 3M would have come all the way down to this orange line, I likely would have just come into this presentation here today and said, let's just buy some shares outright. After all, when 3M has a 3% yield, it is generally an attractive time to be buying this dividend king. This orange line plotted on the chart right here, which comes automated if you're using chart 3A, if you're a premium market scholar, will tell you what the average high yield is for any given dividend company. So remember, every company is a little bit different. AT&T with a 3% yield is not a big deal. It always has a 3% yield. 3M, on the other hand, typically does not have a 3% yield. It typically has a yield closer to about 2.5%. So this orange line is plotting the extreme yields that can be available if you're lucky enough to pick them up at those prices. Now, 3M is a company that I've often lauded in my dividend growth investing classes. Those of you that have been with me for years know that I put it on my dividend growth investing Mount Rushmore as just one example. But the truth is, we haven't had an opportunity to talk about it much in recent years because its price was not viewed as attractive enough to be putting in a new position. What I mean by that is you'll notice as you look at this chart here, which is a 10-year chart, that these years recently, the price action has been well above those orange lines. The last time you've been able to buy 3M at the orange line was early 2016 right there, and you also had an opportunity late 2015 there when my class was buying it. Since then, you haven't had a whole lot of opportunities, but you'll notice after today's beatdown from an earnings perspective, it got awfully close. It didn't get right there, but it was very, very close. And so we're not to the point where we're willing to pull the trigger quite yet from just buying the stock outright as a long-term position in our portfolio, but this is the type of setup that makes some sense for selling puts. Because what we can do when we're selling puts is we can try to select a location on the chart where we want to become a long-term investor in a particular company if that price is not available now. And at 192, it's not necessarily available right now. We would love to buy it down here at 180.73 or less, because that would tell us that the price is then yielding 3.01 or more. Right now, its yield is only 2.83%. So what I'd like to do is take a look at the option chain to see, can we sell a put close to $180 to hopefully achieve that end result where we want to buy that stock at a lower price. And if that doesn't come to fruition, at least we will make some money off the premium itself when we sell that put. So let me come on over here to the trade tab. And we already have a position on it. In fact, this one's kind of interesting down below, because you'll see this was actually the portfolio where we bought this stock. I was mentioning in late 2015, we bought it at $136. So we actually have 73 shares in this particular paper money account already. But what we're going to do here is different than just the shares outright. What we're going to do is we're going to look at an options contract to perhaps add even more shares to our current position. And so as we take a look at this, you'll notice that the 180 strike is right here. Now I'm looking at the November contracts with 24 days till expiration. Remember, this is earnings season. They reported earnings today. So hopefully the really bad news is out of the way. It's sometimes a little bit more dangerous when you're selling puts through an earnings season. So it's nice that 3M already reported this morning. And so hopefully there's not another big landmine in front of them. Doesn't mean that the stock can't continue to go down. It just means that, earnings are out of the way. So hopefully that allows us to avoid that potential landmine. So when we look at 180, remember that was the area I wanted to focus on, because at $180, 3M is yielding 3%. Historically, that has been an attractive time to be buying that particular stock. So if we can get that done for $1.80, I think that is a fair opportunity for us here today. And you'll notice that the last traded price for that particular contract was $1.79. So we're right there in the neighborhood of $1.80. I'd like to get at least 1% of the strike generally when I'm selling these puts. So we will go ahead and click the bid price here. We'll set this up. I am going to change this to $1.80. And we'll hope to get filled on that tomorrow, or perhaps the day after. We'll put it in as a good till cancel order. I'm only going to do one contract here, because remember, one contract controls 100 shares of stock. So you've got to be willing to put that capital out there if you need be. So we're just going to do one contract here, keep it nice and simple. We'll take in $180 to say we are willing buyers of 3M at $180 per share, even if we're not willing buyers at $192 per share. So one of two things will happen. Either 3M continues to fall for the next 24 days, and if it closes below $180 on expiration day, then we have to buy that stock at $180. If 3M goes sideways, goes up, or just goes down a little bit, it just doesn't go down $12 or more, then what we will do is we'll keep the $180 that we're taking in right now as a premium right here. So I'm going to click confirm and send. And there's that $180 that's coming into our account right now when we place that trade. And we'll see how we do with that first thing in the morning. All right, well, I want to thank you for joining me here tonight. Another rough day in the market. October has been an ugly month. We remember 1987 as the crash of 1987 in October. We remember, although we weren't alive at the time, in the 1920s, we had a crash in October. So there's these haunting elements of October that always kind of creep up in the back of our mind. The good news is this: from a calendar perspective, if you look at the Stock Trader's Almanac, typically November, December, and January are considered the best 3 months of the calendar year. It's not a guarantee that'll happen every year, but historically, if you go back and track all the data, November, December, January is a very promising time for the stock market. So hopefully we're getting closer to the end of this downdraft in the stock market. If not, stick with us here on these videos and we'll be with you every step of the way. With that, I want to wish you all the best with your trades and your investments. Goodbye for now.